you very much for joining us today to our panel, Sponsor-Led versus Sponsorless Deals. My name is Kerstin Kuberneck. I'm Senior Private Debt Reporter at Levin Insights, and my panelists will introduce themselves, starting with Kirsten next to me.
Thanks, Kerstin. I'm Kirsten Both. I'm co-heading the European private debt activities at Muzinich. Muzinich, for those of you who don't know us as a company, we are a credit-focused asset manager. We manage around $35 billion assets under management in high-yield bonds, investment-grade bonds, syndicated loans, and the private markets activities where we are active on a global basis.
Yeah, welcome also from my side. Markus Geiger. I'm representing ODDO BHF. We're a Franco-German financial institution, around 150 billion of third-party money, fairly equally split in wealth management and institutional asset management. And as part of the asset management division, we have private assets spanning across a number of strategies, of which one is private debt, corporate direct lending, with a particular focus on the lower mid-market, mainly in the German-speaking region, but also in Benelux and France.
Hi, I'm Jack Gilbert. I've been working in private credit for 15 years, all of that time at PGIM Private Capital. We're a large asset manager, manage about $100 billion in private credit. 10 billion of that is in direct lending, and that's split about 50-50 between the sponsored and non-sponsored. So the platform set up to originate in both those markets, and when we pivot between them, depending on market conditions. So look forward to a discussion.
Hi, and my name's David McCaig. I'm the founder of Many Waters Capital, which is a specialist independent debt advisory business based in London. We've been going now about 6 years, and we help primarily financial sponsors, but also work directly with independent companies, some listed, some private. We work across Europe, but largely in the UK. I used to be a lender. Although I started out, I was once diagnosed a lawyer, but that didn't last very long. And I moved into banking, Morgan Grenfell, back in the early 90s, where we worked on some of the early leveraged finance deals before moving into asset-backed finance. So I used to go to the Barcelona conference organised by Euroweek and all these guys, so it's quite nice to go full circle. I ended up at Deutsche Morgan Grenfell, where we were one of the bigger ABS teams. We did a team move to West LB at the end of the 90s and got involved in some quite interesting acquisitions where we refinanced the business through securitization. And I ended up running global emerging markets at West LB before moving to Standard Bank, the big South African bank, during the financial crisis. My last real job was running the lending worldwide at Standard Bank. At the end of that, I had all the fun I could ever really take in lending and banking. And we had a little time out, and actually old mates came and asked me to help them with their borrowing. And the main one that got me going was a pal with a concrete company, 50 million of EBITDA, and he was having a headache with his bank, so we helped him fix that, and he insisted on paying me. And as a consequence, we gradually set up the business, and 6 years later, we're doing some quite interesting deals. So the largest sort of deal we've done recently, not quite public, it'll be public very soon, was £800 million, which was committed just before Christmas. That will fund early April and be announced. And we're just closing out something in Ireland, just over 200 million euros for an insurance business. So that's me showing off. We also do £10 million deals.
Thank you very much. And let's just jump in right here. When we talk about sponsorless private credit deals, which segment of the mid-market do we actually refer to versus the sponsor-backed direct lending space? And I'm referring to market size, of course, typical sectors, business types, etc. Kirsten, do you want to start there?
I can start off at least. It's a complex topic, and maybe as a quick background, in our private market or private debt activities, we look at sponsor-driven and sponsor-less lending. We are focused on the lower middle market. So many of my comments, similar to Markus, are probably referring a little bit to the smaller market segment. And clearly, sponsor-driven deals are companies which are owned by private equity sponsors. Sponsor-less are typically private companies. Sometimes they're listed, but very rarely in the hands of families or founders. And what I would say, and typically the interesting thing in Europe is that 90% of all companies are not private equity owned. So it's a huge segment. But if you look at the private debt and direct lending activities, then actually pretty much everything is in the sponsor-driven segment. So it's really the case that still the sponsor-less market segment is pretty much underpenetrated. If you look into the US, it's a different ball game. There's funds which focus purely on sponsor-less strategies, so the market is more mature and has developed due to the fact that banking consolidation has progressed further. So with that, on the sponsor-less side, I believe you see a much broader spectrum of types of companies. So for example, you might see funds which focus on specific sectors. So I spoke not too long ago with somebody who just focuses on climate tech, so you go into the specialization. I think on the sponsor-driven side, you typically focus on companies which are, buy and build type companies, often in sectors like business services, software, healthcare, very recurring, high cash flow generating business models. Whereas on the sponsor-less side, you might encounter security structures which are more based on assets. So as a result, you might be going more into the industrial segments. In terms of purpose, again, on the sponsor-driven side, it's typically for acquisitions or then add-on activities, whereas on the sponsor-less side, it might be something which happens on the shareholder basis, might be, one sibling buying out another sibling. It might be CapEx, so building additional facilities for the company. It might be pre-IPO funding, so the variety of needs in that segment might be much broader than the typically sponsor-driven side. So I stop here, and I'm sure other people have more to add.
Yeah, maybe when we look at market size, obviously, as Kirsten has said, it's difficult to get our arms around statistics because regular bank finance in the region will not show up in any published numbers, but there is at least a difference that is well documented in terms of the smaller mid-cap companies in the different European countries. And obviously we're very much focused on the DACH region, sort of German-speaking, and there, if you exclude the very small companies, which is around 3 million very small companies, and if you take those off the equation, you still get to 450,000 to 500,000 SMEs, which have a decent size, sort of as of a number of employees and a certain revenue that starts becoming relevant. And that number is much bigger. 2 times as big as the equivalent in Italy and 3 times as big as the equivalent in France. So much more of the sort of industrial or sort of economic value creation, for example, in Germany, is derived from small mid-cap companies compared to other jurisdictions. So whilst obviously a lot of those are equity financed to begin with, and then if they take sort of debt onto the balance sheet, it's oftentimes relationship based with a house bank. And we might come to that later on, whether we see trends that this is cracking up. But generally, just the sheer volume of small mid-cap companies varies by jurisdiction. And what we encounter is obviously there is a very broad range of also, when you look at statistics like the world market leader, the hidden champions, there again you have over proportionate number of those successful SMEs in our region. So that gives us, I think, a good base to look at sponsorless deals, just from the volume and the quality of available companies.
Yes, I think when it comes to defining the market, everyone will look at it slightly differently through their own lens. I mean, we do a lot of PLC finance, for example, in the UK. Some people would call that sponsorless. It's obviously at the top end from a size perspective. At the bottom end, in terms of sort of how small would we go, I think we set that limit at 10 million for a sponsored business and 15 for a sponsorless in terms of EBITDA. And that's quite purposeful because I think we think 10 sort of corresponds to 15 in terms of by the time you take out the sponsor, do you get the same resilience? Do you get the same level of governance? And so, interesting to note that differential.
So we look at it a slightly different way because there's just so many sponsorless companies we can't even begin to try and market them. So we arrive at them in a different way, and it's quite often from a sponsor who may have been introduced, or a financial advisor may have been introduced to the sponsorless company. They haven't bought them, but the company needs a refi, and we get a call. So it's a lot more straightforward to identify and market to the financial sponsors, and that's where we apply our resources. I mean, we're not small for a debt advisory shop. We're 10 people, but that's tiny when you're looking across the world at the bewildering array of sponsorless companies.
Yeah, and speaking of sponsors, we don't have the private equity fund that could provide the deal flow, right, in the sponsorless space, usually. And so what does this origination actually look like from your perspective? How do you actually originate the deals that are not thrown to you by private equity fund managers? Markus, to you.
Yeah, well, that's actually tricky for two reasons. First, they need to find you, and second, they're not necessarily having recurring business, whereas a private equity fund will show you 20, 30, 50 deals a year. And it might be that a CFO in a small regional SME has a once-in-a-lifetime financing project that he's asking you to support. So I think it's tricky in these two aspects. I mean, first there is specialized advisors. I mean, people like David who would then obviously help facilitate the discussion, and we actually quite like that because not only does it channel the deal flow, but also it brings some reasoning and professionalism to the discussion, which oftentimes, a founder or CFO of a regional company might not have a good feel for what is market standard in these type of transactions. And then there's more esoteric ways. I mean, for example, we have our wealth management practice in-house, and they focus on entrepreneurs. So we get a good portion of our sponsorless deal flow actually through our wealth management channel, which is good because there's already an established relationship, a trustful relationship. And when they finished their discussion around art pieces and classic cars, they might as well have a little side discussion on financing needs of the operating business, and that's where we can come into play. And then, I mean, other than that, obviously there is we had a previous panel, and we know that some funds like Tres Mares, they're trying to proactively go through databases and sources of company information to identify sponsorless opportunities, just like the M&A advisors. And a lot of people are working with banks, leasing companies, factoring companies, so other financing providers that might not necessarily be in competition with what you have to offer, particularly when it comes to sort of asset-based finance, like factoring, leasing, and so on. They would not do a structured loan for an acquisition of a competitor. So I think you need to forge a lot of partnerships, and within a bigger group that can be in-house, and otherwise you need to partner up in the market. Some work with local banks also, that the bank would take a portion in the balance sheet, and you as a fund could benefit from maybe larger volumes that you pick that up, and there are some specialized advisors, and I think there's a lot of groundwork also required to really tap into that deal flow. And the problematic is mainly that it's not a systematic deal flow.
Yeah, I mean, very much agree with that you can source sponsored flow with a small number of very high quality relationships, whereas on the sponsorless side, what you really need is breadth and power of the network. I mean, we take about 3,000 meetings every year just in Europe, directly with borrowers, directly with companies, and that's really what underpins our origination in the space.
So we don't go looking for sponsorless deals, but we like them when we get them because quite often it's the first institutional capital going into a company. And when that's the case, and it's a good one, then it's a wonderful thing to be involved in because for us in the long term it's good currency, if you like, with private equity sponsors who ultimately produce more volume for us. Now, a first-time borrower, a new company to any type, not necessarily first time, but a sponsorless company is generally harder work. Now, it's not always the case. When you have a private equity sponsor, there's never a question about getting diligence, financial and commercial. Financial sponsors are tremendously skilled asset managers, so the company will be run with a certain amount of discipline. They ought to have the data cube and the information and be able to explain the narrative. Quite often with a sponsorless company, you are doing the first proper deck. You're taking them all the way through it. As I said, we don't go looking for it, but we do find them, and they're wonderful opportunities when you do get them. We often find that the process is a bit more involved, and we look at it as lenders. Everyone at Many Waters Capital has been a lender before, so we are careful to try and win work that we know executes because we're paid at the end, not for the efforts. So we've got to get that judgment right, and it's a hard thing to do at the beginning of a deal because you've not done the diligence. You're meeting people, they're in the door. So the quality of the introduction, the way the transaction comes into you, that's really the challenge when you see a company out of the blue, and that actually never really happens because there's always a reason they come to you, and that is the beauty of network. So we don't go looking for it. It comes to us through network, and with a good quality network, you get good quality and decent opportunities, which then hopefully work well with lenders.
Kirsten?
Yeah, fully agreed. It's about breadth of network, not focused network, and something which is really relevant, at least in the lower middle market segment, is the local presence. Because if you deal with smaller companies, they are not used to engaging maybe with more international, professionalized counterparties. So it's a huge advantage to be able to connect with them locally, speak the same language, maybe have the same network or overlapping networks and all that. So that is really important. As well as kind of was indicated, the conversion ratio for us is a lot lower. So for the amount of deals we see on the sponsorless side, we take a lot fewer forward because we are indeed concerned about the amount of time we would spend on some of them where just no information is prepared in a way that we can actually use it. And clearly, last thing which wasn't mentioned yet and wasn't directly part of your question, but which is, I believe, very relevant, is having in your teams resources which can deal with the added complexity, which might be, you need to scope the diligence. It's not just put in front of you. You need to be able to ask the right questions. So it's a deeper kind of private equity style skill set which needs to be present in the team. Otherwise, you shouldn't go about doing those types of deals.
And speaking about private equity, there has been a lot of talk about valuation expectation mismatches between sellers and buyers, right, in the private equity space. Is that a theme in the sponsorless segment at all? And how do you actually value the deals? How does it work?
Yes, I think the valuation gap is of course less relevant because inherently, if you've got less companies being sold to private equity, there's going to be more activity in the sponsorless market because these are potentially primary LBOs that have been pivoted into other types of transactions, whether it's refis or recaps. So we do see it as a little bit of a counterbalance. When M&A is high, we'll do slightly more private equity back flow, and when it dips, we'll do slightly more non-sponsored flow. So we do like the way that it smooths out origination through the cycle. That said, I do think there's a tendency to underestimate the differences, and we actually have separate teams working on non-sponsored transactions to sponsored transactions, just because I think as we've touched on, the diligence threshold, the type of interactions you might have with management, the portfolio monitoring cadence, the importance of governance is so different. And I think if you're doing 9 sponsor-backed deals and you pivot to do 1 sponsorless deal a year, that can be a bit of a trap if you apply the same processes and same underwriting approach. So we have quite separate teams that work on them both, but both leveraging the same origination network, same investment committee, and we found that to be a successful approach.
And in the sponsor-backed deals world, we nowadays see club deals with 2-3 lenders being involved. What's the situation in the sponsorless space? Do you club with other lenders as well? Do you collaborate with other lenders? And what does it look like? Markus, to you.
Yeah, I think it depends on the individual lender. We would generally be open to that, also for sponsored deals. Due to ticket size and our interest in engaging in slightly bigger borrowers than the ticket size would suggest. On the sponsorless side, what you often have is sort of still some existing local financing partners. Can be real estate finance, can be some factoring. So you're typically dealing with sort of non-credit fund, non-leverage finance bank partners in a structure, and you can either try to replace all of them, but sometimes they're happy, and it's obviously not so expensive to have a factoring line and a leasing facility. And you probably need to engage with those and agree on a structure. But typically they are operating off a basis of individual real assets as security. So you can single that out fairly easily. It can be one piece of real estate or it's the account receivables for factoring. So then typically with regards to your security base, that can be singled out fairly easily.
And is there a collaboration with banks in that segment as well? And how strong is that collaboration, David?
Yeah, so we work with banks every bit as much as we work with direct lenders. And as I was running out the door, I got one of the youngsters to just add up the bank deals against the direct lender deals. And I was surprised that it comes out at basically 50-50. Not so much on volume, but in number of deals. So it was like 40 since we got going. Clubbing is more about the size of the transaction. And when you consider, something we did just around Christmas, I briefly referred to it before, that was £800 million, and one direct lender took the whole thing down. Now, it was a bit weird because that was a large chunk of change for them, for any direct lender. And between us and the sponsor, we agreed as a group that we would make every effort to help syndicate the underwriter down. So it's not that, I think that's quite unusual. But again, we're all ex-bankers. We've since sold the direct lender down by 50%, and it's looking like a triumph. In terms of banking more generally, we work with banks left and right. So quite often around some of the smaller transactions where there's less leverage required and tighter terms, tighter pricing, because if it's sponsorless, they're a little bit stingier about what they'll pay versus a private equity investor who might be more agnostic about the cost of debt. If they get their equity case right, a few shekels on the debt return is actually irrelevant. So quite often, the smaller transactions up to 10, 15 million EBITDA will quite happily go to a bank market, a group of banks. But we work with banks all the way across the size spectrum, whether on bigger transactions, we're putting in place a super senior revolving credit facility, and that can be 1 or 2 or 3 banks. And we don't do it that often, but these bigger transactions, we quite often create a bit of pricing tension by bidding out the investment banks on a high yield bond or TLB. So, the banks are there. They're wonderful things. And we are really blessed with the variety and quality of lenders in the market. I've lost count now of the number of direct lenders. So it's a great thing to be able to seek to navigate that and find the right lender for the right borrower. And that's absolutely the most important priority. It's not always about cost, it's about flexibility, terms to some extent, but also the character of the relationship and getting people together as partners, because it's not about the debt advisor, it's about the client and the lender and the journey they're about to go on.
Maybe just to add to that, obviously one question is how can you collaborate between funds and banks, but another question is how will that landscape evolve, and our hypothesis is pretty much that the sponsorless market, as Kirsten has pointed out, it's like 90% of the transactions or 90% of the companies are not owned by financial investors, so their financing doesn't show up in most of any of the statistics. So there's a broad market out there, and that's a banking market essentially. It's not readily available for us. So out of the transactions that we as an industry are doing, statistically only like 10 to 15% are sponsorless, but we believe that might open up more for various reasons. One could be the supply side, so that actually banks are they're driven by, they're constrained by regulation. I think that's not a particularly new issue, but also in economically difficult times, they're having obviously tend to have a more traditional portfolio also. They would have, in our region, they would have a very industrial portfolio of companies that obviously go through a lot of transition, and they would have a lot of real estate. So they would be very much also constrained by their risk-weighted assets due to their portfolio composition. And then I think the third element is obviously you see that we as an asset class are getting through the crisis fairly well. If you take the sort of set of crises that we had since COVID, I think the asset class, private debt, has fared fairly well, which will increase also the confidence. And as a last point to that, we were lacking structural growth in Europe. So the smaller mid-cap companies, they need to move out of the comfort zone to generate growth. They need to acquire competitors. They need to go to the US. They need to create new business areas. And all of these projects are not typical projects for the house bank. And if you take these factors in combination, I believe banks will still be around. But I would guess there are fundamental drivers that the sponsorless market will open up for credit funds more than today.
Kirsten?
Yeah, kind of coming back to your original questions, I fully agree with the size question. Clubbing with other funds is size driven. I would say, given there's less private debt funds focusing on sponsorless, and they're all pretty unique in approach, it's more difficult to have clubs, whereas kind of sponsor-driven direct lending deals are very, I would say, there's a standard how they're done, so it's easier to club up. That's maybe one comment, and fully agree on the banking side. I think a window will open up for sponsorless deals due to the banking constraints. So I believe it will move into the direction the US is moving already.
And do you expect some more competition from other fund managers that usually do not penetrate your market. Large cap, for example, I heard high yield bond fund managers out of nowhere started to look into that space as well, apparently. So do you expect more competition from there?
I mean, overall, I would say not dramatic shift, but indeed, I mean, there is the Nordic bond market, which has moved into Germany, for example, and is launching some deals there. We haven't seen it at huge volume, but clearly that's an interesting dynamic to observe.
I mean, there's competition everywhere, clearly, but I do think the sponsorless segment is one of the better protected parts of the market as a whole, just because of all the points we've touched on. It's harder to do, it's deeper into markets, it's more relationship driven, and so I think it's less suited to people coming down and selectively doing the odd deal.
Time flies when you're having fun. 11 seconds, 10. Thank you very much. It was a very interesting conversation, and I hope you enjoyed it. Thank you.
Thank you very much to the panel. That was fantastic. And we now move on to the final panel of the day. What does the future hold for the European private credit market? So I'd like to welcome the next panelists to the stage and thank the outgoing panelists.